more revision in less than 15 minutes. So today, we're going to look at the partner's current account. All right, so remember the appropriation we did last time. Now we're on to the partner's current account. Right, so the current account, or the partner's current account, will be the double entry then to the appropriation account. If we recall, the appropriations where we shared the net profits. So now we're going to see what happened to that share. And it will be either displayed separately on the balance sheet. You know, if that business is using what we call a fixed capital account, so you wouldn't change the initial capital of anything. You just show the change in the current account. Or they may be using a fluctuating capital account, which means that the capital changes with the change in the current account. So you subsume everything into one. Anyway, don't worry about it. The examiner will give you directions on that. Alright, so the partner's current account then reflects how the partner's equity, or their interest in the business, right? How has it been impacted by their activities in operating this business during the period under review? So there, like the appropriation account, we divide this into 6 steps, to make a sort of easy comparative way of remembering things. So step number 1 would be obviously to register the opening balances of the partners. In other words, what changes were made to their equity last time, in the last time period, right? You put those as your opening balance, and then you start on this period to find out, obviously, what changes will happen this time around. So we start with the opening balances. And then you will add to those opening balances all of the gains that the partners made on the appropriation account. And you would know this because on the appropriation account, you would have deducted all the gains of the partners from the profits that were available at the end of that year. So everything that you deducted on the appropriation account, you're going to add on this current account. So you can see you're going to be adding the interest on capital, the salaries, the bonus, the share of profits, because these were the things you deducted on the appropriation account. And then what you do is, if any of the partners had loaned the business money, then any interest that is being paid out to them, you would now have to include it in their share, in their gain on equity, right? Because obviously the money is theirs. So notice that you're going to add any loan interest any partner may be entitled to. And in normal practice, if nothing is said, really and truly, I think it's about 5% you would add charge on that interest on capital. But you could follow the laws of that country and see what of your country and see what it says. Now, once you've done that, you go to step 4, which is that you're going to sum up the opening balance plus all the gains, including that loan interest, if it was there, to find the total gain so far in their equity. And then what you're going to do at step 5 is that you're going to take away from that gain that they just made the amounts that they withdrew out of the business. In other words, whatever losses they incurred during that year. So obviously there are only 2 types of losses that they're likely to have incurred, and that would be the money that they took out in drawings and the penalty for having taken out that money. So you'll be taking out the drawings and the interest on drawings from those gains that they made. And step 6 says that would tell you the net gain or loss in equity. In other words, the difference between what they gained and what they lost will be now their new balance. So this will be the net change in their equity for the period that we reviewed. All right, so let's look at it from a sort of review position. So remember, step number 1 would be to register all of the opening balances. All right, so register their opening balances. So I got the balance brought forward for A and the balance brought forward for B. Now what you need to know is that if any of these had a negative balance, in other words a debit balance, because remember all capital balances are credits. So if they had a debit balance, it would mean that their balance would be negative, as in that the change that would occur on their account is that they lost instead of gaining. All right, so just keep that in mind. Step number 2 says transfer all the gains that each partner made, and you can look into the appropriation account and find all those gains, right? And step number 3 says to record any interest that they would have gained from any loans that they may have made to the company. Now, generally that don't really show up, but if it does, you look for the percentage and you would add that interest onto the partners. So let's do that now. So there we have it. I have these are the things that they would have gained. They would have gained the interest on capital. So you add that on. They would have gained a salary. You add that on. If there were any bonuses, for example, you add that on. And of course, if there was a loan interest, you would add that on. And of course, they gain the share of profits because that's what you did on the appropriation. So all these things you would put in, right? And then step 3 says we'll add all of them together. So add all these gains onto the balance to find out what is the total gain so far, right? What was the total that they gained? All right. And then once you found the total that they have gained, then what you do now is you're going to take away from them the things that they lost. In other words, what they took out of the business or had to pay for taking it out. All right, so just like in a sole tradership, you will subtract drawings. In this partnership, you're going to do the exact same thing. So you're going to take away the drawings and the interest that you had to pay for taking out those drawings in the first place. All right, so hence we do that now. So I have the drawings and the interest on drawings. I find the totals. And the reason why I put them negative is because I want to take them away. You could just leave them and just follow the instructions, but just guiding the average person to see, well, I'm going to be taking this away from that total. All right, so as step 6 says, we're going to find the net change, and the net change is simply the difference between the total that they gain and the total that they lost, and that will tell you their new balance. In other words, what is the new change to their equity. And again, as I said, if one of these figures come out negative, it means that the person lost instead of gaining. All right, so just remember, because sometimes the examiner say, well, what does a negative balance on the partner's account, current account mean? It simply means that they lost the amount. All right, the equity went down instead of going up. All right, so there you have it. That's the partner's current account.